By the end of today's Mindful Investing Part 3 of 3 presentation, you'll be able to manage half a lifetime of personal finance. It'll only really be when things get complex that you may want to consider working with a professional. This complexity could come in lots of different forms. You may not understand how to line all the moving parts up. You may simply want someone else's eyes on the problem, sort of a quick and dirty decision review. You may have more assets that you're comfortable managing yourself. You may have more in-depth questions or questions about plan assumptions, or you may simply be busy doing other things and want to have someone else as kind of a trusted partner paying closer attention. Let the reasons that you want the advice guide you to the right kind of advice provider. And by the time you get there, you'll have many sources of advice to choose from. For today, stay engaged, take notes, write any questions you have down and ask them at the end here if we have some time, or via social media channels when it's all over. And remember, this is general information and education. Everyone's situation is different. Please don't think of this as specific recommendations. Think about what you learned today, and then before you act, ask questions, get more specific answers suited to you. Most financial decisions involve trade-offs, and all investing involves risk. What we're trying to do today is get you on a solid foundation so when you do start investing, you stick with it. It's the plan you stick with that will help bring you to financial success. Now, I know we have a lot of new people tuning into this webinar, so I want to start by going over the first two parts of the investing piece, one slide at a time. In the first session, titled Before You Invest, we learned two things, essentially. The first thing we learned was we're hardwired to make financial mistakes because there's no practical financial education in schools, because we learn family money stories before we know we're learning anything at all, and because our financial decisions are tied up with lots of emotions. We discussed some of the things we need to take care of also before we start investing. Things like creating a habit of savings, life planning, having emergency funds, risk management, and debt reduction, especially if you carry any high interest debt. And then we focus on a simple idea. It is never what markets and economies do that make you financially successful. It is always what you do. You're going to hear me say this many, many times. It's what you do or don't do that makes you successful. Anyone can follow some simple steps and become. In our second session, we introduced a global asset portfolio that represents all the stock and bond investments available to us at any market in the world. This can be your default starting point for your asset allocation. If you can buy everything, this is really close to what it would look like. Any decision that wavers outside of this breakdown is a statement that somehow the world has it wrong and you know something better. I'm not saying that this isn't possible, but it's unlikely, and I believe it takes more energy and work than it's probably worth if you don't spend every day with this kind of stuff. Anyone that makes a claim of superior knowledge can be proven right or wrong after the fact. There is no way to tell in advance who is who. And quite easily, one can simply dial their risk up or down by increasing or decreasing their total equity market exposure, as is appropriate for your plan. These four portfolios represent the dialing up and down of risk levels without changing the allocations within stocks or bonds. If you want, you can simply select one of these, risk level appropriate to your plan and circumstances, and calmly invest in it, knowing that you own the universe of opportunities. While some part of your portfolio may lose favor with some other market participants, another part of your portfolio will be gaining favor. In this way, we nullify the market's popularity contest. It doesn't protect you against losses. It just keeps you on plan longer time. And this is the simple part. Once you begin investing, that's where the real work begins. With that, I'd like to welcome you to our third and final installment of Mindful Investing. We call this one, After You Invest, the Mental Game Begins. After almost 35 years of investing my own money and watching my emotional response to markets, and nearly 20 years helping other people invest their money and watching their emotional responses, I can tell you that people succeed or fail based almost entirely on their ability to keep a steady hand on the wheel when things do not go the way they expect. Because they never go the way we expect continuously and permanently. There are always surprises. No matter how you invest, a large portion of the world will invest differently than you do. At any one time, there will be many people, indices, portfolios, styles, methods of investing that are outperforming you. This is just because they are in season. All media and financial punditry are trying to get you to change your portfolio to match their idea of what is currently in season. Remember, seasons change. And if you constantly chase the portfolio that's in season, you will fail. And what's worse, you will be constantly filled with financial anxiety. The whole reason for today's presentation is to help you understand that these investing seasons do change. We want to counter the psychological fear and greed that will most certainly cause you to question what you're doing. And these questions are fine. They're okay to have the questions as long as they remain just questions. You're allowed your feelings, but I do not recommend acting on those feelings. All evidence suggests that doing so is harmful to both your wealth and your happiness. We act on our plan. We do not react based on the feelings about the changing investment seasons. And to react or not to react, it turns out, is entirely in our control. Today, we're going to create successful investors. And I mean this in all seriousness. All the stuff we talked about in parts 1 and 2 are meaningless without the ability to deal with surprises both calmly and patiently. And this is where those actions will be tested. Since 1945, there have been 13 periods, 18 years in total, where the S&P 500 has been in bear market territory. There are no consistency of causes or severity or duration. Each one is different in its details, but all are similar in two very important ways. First, they were not predicted. Second, they ended, and markets recovered long before it was expected. Each one, in turn, added one additional period where the world threatened to end, but did not end. The most recent one, like the others that went before it, though media gets louder and louder over time, we might recall, was accompanied by the headlines like, "The end of capitalism as we know it," or "Will the stock market ever recover?" But 3 short years later, and everything was moving along as it always has. 2 steps forward, 1 step back. The sun rises, the sun sets. On average, we see a bear market once every 5-6 years. On average, they fall 1/3, roughly 33% from peak to trough. On average, they last 15 to 16 months. Winter turns to spring, turns to summer, turns to fall, turns back to winter. Markets ebb and flow along with human psychology, excitement, and greed. Today, we attempt to prepare you for the challenge of investing in markets that go up and down unpredictably. And this preparation begins by looking at any particular market. You may recall this bell curve from school. It's often used to display volumes of data that have a regular pattern, and it turns out that this bell curve represents the returns from all the portfolios everywhere quite well. The vertical line is the average investor return, not the average market return, the average investor return. Notice near the vertical line, there are many more portfolios stacked up. To the right, there's a large number of portfolios that are outperforming the average by varying degrees, though there are fewer and fewer the further away we get from that average portfolio. To the left, there's a large number of portfolios that are underperforming the average by varying degrees, and notice as we get further away from that average, there are fewer and fewer portfolios. All portfolios tend to cluster around the central tendency, and they take turns outperforming and underperforming. One investor's ideas are in favor this month or year. Another's are in favor next month or year. There is nothing predictable about who will be on top during any particular time period, and no one has been able to maintain a consistent top position over long periods of time. This is a long-winded explanation for the simple statement: past returns are no guarantee of future results. Now, I know if you're here for parts 1 and 2, you've seen this slide before, and if the primary way we learn is through repetition, then I want to hit it one more time, and I want it to be a very powerful lesson. Again, no one can predict the future. It's the stuff of crystal balls. There will be many predictions at all times. Some of them will be right, some of them will be wrong. Their ultimate results will fall on the bell curve we just saw. The least crazy positive or crazy negative ones will stack up in the middle of the curve, and the really crazy negative ones and the really crazy positive ones will end up on either tail of the curve. No one will know which of these predictions will be right or wrong. But the ones that turn out to be right will sing it to the heavens. They'll write books about how smart they are, and books will be written about them. They'll be interviewed, and investors will start to copy them. And the ones that turn out wrong will quietly slip away. And then the very next day or the next month, they will all make more predictions. And again, looking forward, no one will know which will be right and which will be wrong. And this will repeat until the investors who claim knowledge lose their money, or as often as not, lose your money if you're listening and following them. Do not select investments based on predictions, impulses, tips, hunches, or media pundits. They do not know you. They cannot know your plan. And even if they did, the research very clearly shows that conventional investing has low odds of success. Trying to pick this stock or bond and avoid that stock or bond fails to even keep up. Over the 10-year period ending in 2013, only 19% of stock managers and 15% of bond managers survived and outperformed their benchmarks. Said in the reverse, 81% of stock managers and 85% of bond managers who started that 10-year period underperformed their market. About half of the stock and bond managers didn't even survive the 10-year period. So, should we be surprised by this poor record of performance? I don't think so, not really. It actually makes perfect sense if, as we said in Mindful Investing Part 2, market prices are the best estimates of actual value. Remember, manager underperformance isn't necessarily due to a lack of knowledge or expertise. In fact, many professional investment managers are very bright, very well educated, and incredibly hardworking. The problem is that this high level of broadly shared expertise and motivation results in intense market competition, which does nothing else except drives prices closer and closer to fair value. It becomes more and more difficult to find a great outperforming investment when everyone is looking for it. Still, some investors try to improve these odds by picking managers who have outperformed in the past. They hire the ones that show up to them from the right side of the bell curve. Unfortunately, there's a lot of research into the persistence of manager performance that tells us that among those who outperformed in the past, only a small fraction continue to beat their peer group or benchmark in the future. So let's look at this chart and look at this idea of lack of persistence specifically. Let's take the 2,711 equity managers that managed money for the full period from 2000 to 2009, 10 years. We pick the top 25%, the 682 managers that outperform all the rest, reasoning that their recent outperformance is likely to continue in the future. Does this assumption pay off? The research offers strong evidence to the contrary. As this chart illustrates, of the 682 top-performing managers, when reevaluated for the following 5 years, only 28% continued in the top 25%, and only a little better than random. Some U.S. equity managers may be better than others, but they're hard to identify in advance using performance. Returns contain a lot of noise, and impressive track records often result from good luck. The assumption that past outperformance will continue proves faulty and leaves many investors disappointed. The total of the average investor disappointment is summed up in this chart. Dalbar Inc. has done this study for 20 years, every year for 20 years. And don't take my word for this. Google it, read them, read the current version, read past versions of this study, breathe it in, swim in it. Every year for 20 years, the average investor has given up roughly, varies a little bit from year to year, but it's given up roughly 2/3 of the performance of the very markets they're invested in and has barely beaten inflation over the long term. The only difference between the investor who invests in all these markets and the markets themselves is this. The investor buys and sells at the wrong time for the wrong reasons. They buy out of excitement when listening to pundits tell them it's time to buy, and they sell out of fear listening to those same pundits tell them it's time to steer clear. They continue to try to optimize their portfolios with superior knowledge. Perhaps you share this experience or know someone who's had this experience. If so, it's no wonder you're looking for a better way. When you are investing, it isn't what markets or economies do that matters. It's what you do. Your actions and inactions are the dominant variable in your investing success. Full stop. The secular religion of performance, while it has already failed, absolutely rules financial product manufacturing and financial media. They all talk a good game, but the vast majority of those who aim at outperforming actually end up underperforming. We have to start by admitting that we cannot know, and then we optimize on humility. We've talked at great length about the specific actions you should take. We've discussed the things you do before you invest in order to prepare to have a successful investing experience. We have discussed the act of investing itself, the way you should put your money to work, what you should put it into. Now, we must prepare you to fight off the most common, very human behavioral foibles you're going to face. And here it is in a nutshell. You will always outperform some people, and you will always underperform some other people, varying degrees, different lengths of time. You will always outperform one set of indices, and you will always underperform another set of indices. Again, varying degrees, different lengths of time. When you outperform, it isn't because you knew anything more than anyone else. Remember, it is because your particular blend was in season for that period of time. In the same way, when you underperform, it isn't necessarily because you have made a mistake. It is merely because your particular blend is out of season. But you will question it every step of the way. And here's the critical thing. The universe around you will claim that they knew better. And you will want to believe them because you do want the best returns in every period. You'll forget that it's not possible to predict, and they're only speaking after the fact. No one gets the best returns in every period. Commentary on why you should be doing something else is a siren's song. Listening to it, your financial ship will be dashed onto the rocks. Remember the Dalbar study, that last slide. In the world where outperformance is religion, everyone underperforms. You didn't know, don't know, can't know, shouldn't claim to know. They didn't know, don't know, can't know, and shouldn't claim to know either. But they're going to try to convince you otherwise. We cannot control the media, the pundits, or Wall Street, but we can absolutely control how they affect us. We can review the facts and research. We can educate ourselves as to which decisions matter. We can step out of the culture that drives us to claim knowledge where there is none to be had. And through our specific humility, we can access better outcomes, both financially and personally. Now we're going to look at a few of the most common human behavioral challenges. If our financial success depends on our behavior, then we really want to know what might cause us to misbehave. Unfortunately, our brains play a lot of tricks on us that cause us to misbehave. Here's a short list of the things we're going to be talking about for the next 20 minutes. We're going to start with action bias. Have you ever been stuck in rush hour traffic and watched a neighboring lane move and move next to you while you stood still? And finally, you make the decision, you find your spot, you jump over the moving lane. And then it stops, and the lane you just left starts moving. How long is it until you try and move back over? Do you think you've gotten anywhere faster by shifting lanes over and over? When we're stuck in traffic, our body and mind tells us we need to do something about it, anything. By taking action, we convince ourselves that we're in control, even of an uncontrollable situation. But it's totally irrational. We cannot see what's causing the traffic problem, and we don't know how one particular lane moving faster than others will resolve itself. Remember, everyone else is watching too. We gain nothing, and we risk accidents and tickets in the process. The same is true in investing. We don't control markets any more than we control traffic. We cannot predict which investment will do better any more than we can predict which lane will move faster. And small transaction costs and the potential for taxation on gains puts a negative value on most trading activity. The more we stay the course, the better off we usually are. Whether we see someone doing better than us and therefore wish to boost our own returns, or we see a potential risk ahead and therefore wish to protect ourselves against it, we cannot know the outcome of the transaction versus the outcome if we just stick with our plan. Every price currently available in the market is a fair price. It contains all the data that the world knows about a particular investment. Buying more out of greed or selling it out of fear are both speculations. We are plain and simple guessing. What might happen next and moving our investments in line with that guess. Don't do this. Be proactive with your planning rather than reactive to markets. Okay, let's look at anchoring. Anchoring is the use of irrelevant information as a reference for evaluating or estimating some unknown question. When anchoring, people base decisions or estimates on events or values known to them, even though these facts may have no bearing on the event or value in question. This quote from Baz Luhrmann's "Everyone is Free to Wear Sunscreen" is basically a commentary on anchoring. Whenever you hear someone talk about the way it was back when prices were reasonable, politicians were noble, and children respected their elders, they're anchoring in the past. Now, in finance, the prices were reasonable bit should hit pretty close to home. For me, personally, I can't buy a decent fitted shirt today for the price I paid for my first 2 suits in 1996, 20 years ago. And if I went shopping and didn't buy the shirt because it was too expensive, I would be anchoring in a time long past, a time that will never return. And research shows that when we run quick estimations in our head, we often miss the mark because of this anchoring. I'm going to show you 2 problems, give you 5 seconds to do each of them, and then talk about the results. Okay? So get ready. It's a couple math problems. Okay, take 5 seconds to do this. Now write down your answer. Take 5 more seconds to do this. And write down that answer. Okay. What were your answers? Were they different? Were they the same? Either way you did it, and this is probably going to be a shock, the answer is 40,320. Most likely when you started counting, you went from left to right. By doing this, you anchored on the first 4 numbers you calculated. If you got to 4, some people only get to 3. After doing this thousands of times, researchers found that when starting with 1, 2, 3, the median estimate is 512. When starting with 8, 7, 6, the median estimate is 2,250. It's interesting how bad both sets of estimates are relative to the actual answer of 40,000 plus. It just goes to show how bad we are at math and quick estimation in general. But it's also interesting that they are so different. Either way you go, 8, 7, 6, 5, 4, 3, 2, 1, or 1, 2, 3, 4, 5, 6, 7, 8, the answer is the same. But if you start with 8 instead of 1, you end up with an estimation that's 4 times as high. That's interesting. Our mental shortcuts mess up our ability to estimate. Now, I want to look at this in real life. My wife and I just replaced her 2004 Toyota Prius with a new 3 Series BMW diesel wagon. We wanted a car that got great mileage, was fun to drive, was 4-wheel drive, and could get the whole family up into the snowy mountains, and was not an SUV. Surprisingly, not many alternatives. We just thought this was the best choice. When we first started talking about it, I absolutely had sticker shock. The most I had ever paid for a car was the upper 20,000 range, probably 10 years prior, and I was anchoring in this non-existent past. When we started looking at it and doing the research, comparing our options, my anchoring started to shift. I started learning more, and I shifted to the listed MSRP because it's a great car. We loved it. The comparisons were not as good, and there weren't any available. We were expecting to pay even slightly over MSRP. So when our price with the options we wanted came in under MSRP, I felt like I got a great deal. I went from anchoring in history and thinking we were foolish to anchoring at MSRP and thinking we got a great deal. Notice the price is just the price through all of this. Anchoring changes our perception of our transactions. So what do you do about anchoring? A stock, know this, a stock does not care what you paid for it. It is only worth what the market will pay for it at any given time. Remember, the markets and its millions of participants tells us what the current fair price is for any security, and that fair price has nothing to do with your purchase price. Recognize the truths in Baz Luhrmann's song, "Leave the past in the past." Keep it simple and stay focused on that long-term plan. Confirmation bias is the tendency for people to seek out information that conforms to their pre-existing viewpoints and subsequently ignore information that goes against those viewpoints. Upton Sinclair said it best. It's difficult to get a man to understand something when his salary depends on his not understanding it. If you've ever purchased a new car, you know that the minute you drive it off the lot, you see the same make, model, year, and color everywhere you go. Did everyone buy the same car at the same time? Or is this your mind organizing the available information around the markers you have already suggested are important to you? It's also true in our preferred flavor of media consumption. Think of the political sphere. Limbaugh versus Oberman, Beck versus Huffington, Madar versus Coulter. It's likely that if you recognize these names, you have a preference, if not an extreme preference, for one over the other. You may even feel anger when I'm making the comparison. And I'm sorry about that. I'm making a point here. In terms of investing, think time to buy versus time to sell. Do you have a preferred paper or website where you get your news? Or do you have a tablet or smartphone with a newsreader that allows you to control your newsfeed with a simple thumbs up or thumbs down? Either way, you are purposefully selecting things you want to hear more about and deselecting things you already disagree with. Over time, you'll experience fewer and fewer challenges to your views, and your flow of investment information will confirm what you think you already know. Articles from specific news organizations cluster around seemingly predetermined opinion. Readers of those news organizations generally already agree with that opinion and are reading it to confirm what they think. We like to think that we're carefully gathering information to help us make good decisions, but we're not. Instead, we're reaching our conclusions and then selecting the media that confirms those conclusions and supports our preconceived notions. This leads very quickly to our next bias, herding. In my mind, I keep going back to that Dalbar study. You can see it here. It's a simplified version. What is it that makes investors give up so much of the returns that occur in their own investments? When I first started in the financial industry, we talked about the long-term average of the stock market being, between a 9-ish and 11-ish%. It's interesting to look at this number and see that even given the very difficult time in markets between 2000 and 2010, a huge chunk of the last 20 years, we have roughly the same long-term averages. Of course, I have no idea what the future holds, and past performance is no guarantee of future results, but this should be heartening to the long-term investor. The lesson we should learn is that things tend to work themselves out consistently over long periods of time, even when there are crazy periods in the interim. So what did the average investor miss or do wrong? I hope it's obvious. We allow our short-term emotions to influence important long-term investment decisions. Fear and greed and the constant media barrage cloud our judgment and make us feel like buying and selling at the wrong time for the wrong reason. Warren Buffett says that we should run counter to the herd. He says, be fearful when others are greedy and greedy when others are fearful. A brilliant turn of phrase, very difficult to do in practice. And we know that people often do the wrong things at the wrong time. And this is the poster child of how terrible people can be as investors. The solid orange line shows that the returns for the 12-month trailing period from the purchase date. The dotted green line shows the returns for the 12-month period after the purchase date. The bars are the cash flows into and out of the tech sector. Notice, investors did almost all of their buying after tech stocks were up 100% plus for the trailing months, only to experience 50% losses after they put their money in. There were 90 new tech managers who launched their portfolios right at the peak. This is a perfect example of herding that occurs when everyone's new era beliefs become confirmed. Don't listen to this time is different. It never works out. Some big returns are had in a specific area of the economy. These returns attract more investors. More money flows into the sector. Wall Street creates products to take advantage of the hype. Banks provide greater financing to help out. Media fans the flame of excitement, and investors flock to the new idea. The same thing happens in the mid-2000s with real estate. Every person I talked to in 2005, 2006, 2007 wanted to invest in real estate, flipping homes or condos in Florida. Banks were inventing new ways to lend to people who wouldn't pay them back. Media was highlighting the easy money in housing. Wall Street created a new housing index and new products came pouring out. This ended in roughly the same way, with far greater global implications. It turns out housing is just a bigger deal than technology. And the same thing happens with pessimism. After the tech wreck in 2000 and 2002, investors sought safety, and they gave their money to managers who told those stories of safety. Again, the universe around us confirmed our fears that the end of the world was nigh and told us to sell and hang on to anything we had left. We were herded towards safety. But as soon as the equity markets revived, the S&P provided a return of almost 30% in 2003. Investors' appetites for risk came back as well. They pulled their money out of the safe investments and went back into the stocks after the recovery happened. Performance chasing can lead investors to buy high and sell low. Despite the market's ups and downs, investors need to remember that staying diversified and rebalancing is the best approach for reaching long-term goals. So let's look really quickly at why this herding happens to begin with. The simplest explanation is that we really want to belong. We actually learn how to conform in middle school when our friends make fun of us for doing something differently. A gentleman named Solomon Asch did a study where he put an individual in a room with a group of actors. Everyone was asked to look at a chart of lines and determine line X's length in relation to the other lines. When a member of the group intentionally gave an incorrect answer, for example, they would say line X is the same length as line C, 35% of the participating subjects agreed, against what their own eyes told them. If one person from the group gave a correct answer, the subjects all gave the correct answer. People, on average, want to be part of a group, regardless of whether or not that group is correct. In Asch's experiment, the downside to answering correctly is being uncomfortable by risking not being part of the group. One would think this is not such a big deal. The downside of investing with the herd, as we've seen in the prior two slides, is losing large chunks of money when markets fall and failing to participate when markets rise. However, it's very hard to buck those popular investing trends. It doesn't always feel good to be disciplined. Herding hurts us in investing. Daniel Kahneman, a psychologist, won the Nobel Prize in economics for his work on prospect theory. A big portion of this theory involves loss aversion. Loss aversion in economics refers to people's tendency to strongly prefer avoiding losses over acquiring gains. Most studies show that losses are 2.5 times more powerful as psychological drivers than gains. On the x-axis from left to right, the results range from large losses to large gains. On the y-axis from top to bottom, results range from the pleasure or pain associated with outcomes. To the upper right, it's clear that the bigger the gain, the greater the pleasure. To the lower left, larger losses, greater pain. But look closely at the line as it crosses into negative territory. At the point where gaining a little bit turns into losing a little bit, the pain sharply increases with even a small loss. In non-math terms, the chart tells us that people don't like to lose money, even a little bit of it. To better deal with loss aversion, you should devote significant attention to assessing your risk. When assessing your risk, your investment time horizon should play a huge part. If you're planning for something that's 10 years away, this quarter or even this year's performance shouldn't matter that much. If you employ a process of systematic rebalancing, you can largely eliminate the issue's effect on your portfolio. But I still want to look at an example here. Imagine for a moment you're offered $1,000 and are asked to choose between two options. Option A, you're guaranteed to win an additional $500. Option B, you flip a coin. Heads, you get 1,000. Tails, you get nothing. What option do you choose? In the studies, 84% of people choose option A. But check this out. Imagine for a moment you're offered $2,000 and are asked to choose between two options. Option A, you're guaranteed to lose $500. Option B, you flip a coin. Heads, you lose 1,000, and tails, you lose nothing. What option would you choose? The two problems are identical in terms of the cash outcomes for the subjects involved. And remember, in the first group, 84% chose A. In the second group, the majority, almost 70%, chooses B. The phrasing of the question causes the problems to be interpreted differently. People choose the phrasing that minimizes losses over the phrasing that enhances gains. This defines loss aversion. Now, regret is often considered its own bias, and maybe it is. I think it tucks right here into loss aversion. Except in this case, the loss is emotional. Loss aversion considers our aversion to actual losses, and therefore our risk-return trade-offs, while fear of regret looks at the emotional pain we feel from making poor choices. I can experience horrible feeling of regret whenever I make a really stupid decision. Unfortunately, when it comes to investing, even great decisions can go against us in the short run. Investing involves uncertainty, and uncertainty can force us to take less risk than we otherwise would, both because we're averse to taking actual losses and because we don't want to look or feel stupid. Just for fun, I want to place regret in the context of herding. As prices for a particular investment go up, the herd tends to chase the price and buy more. This obviously pushes prices even higher. As we see this happening, we regret not owning more of it, and we wish that we were enjoying those returns. So what do? Well, we have a couple of choices. We can either recognize the regret for what it is, a psychological bias and nothing more, and we can do nothing. Maybe we even rebalance, sell some of the high-priced investment, buy something that's cheaper. Or we can succumb to the bias, leave your plan behind, buy more, and hope that the trend continues. I suggest going with option one. Perhaps the most famous statement concerning regret avoidance was offered by Harry Markowitz. He's one of the fathers of capital asset pricing theory. He knew how to optimize risk and return, but he anticipated his future regrets, not participating when markets rise and losing money when markets fall. And he didn't want to feel like he had made a mistake in either environment. So he did the simplest thing. He split his investments 50-50. He both minimized his future regret and he eliminated his tendency to think he was smart enough to predict the future. This is referred to as overconfidence. Think carefully about this question. How do you pronounce the capital of Kentucky? Is it Louisville or is it Louisville? What will you bet on it? How much will you bet? Oh, the capital of Kentucky is pronounced Frankfurt. Okay, that's just as much a trick question as it is overconfidence. But if you're willing to bet anything on either of these, then you suffer from overconfidence. Not to worry, there's no shame in this. We all suffer from overconfidence. 19% of people think they belong to the richest 1% of U.S. households. 80% of students think they'll finish in the top half of their class. 86% of Harvard Business School students, they're better looking than their classmates. 99% of college freshmen say they're of above average intelligence. Now, in addition to these ordinary humans, the superhuman economists who claim they know get it wrong all the time. The median forecast for the S&P 500 in 2014 going into the year was roughly a 6.5% gain. It gained almost 11.5%, 12%. This is an epic but very common miss. In January of 2014, analysts everywhere were calling for increases to oil prices, inflation, unemployment, and interest rates. They were wrong in every case. In the case of oil specifically, the consensus was for $95 a barrel at the end of the year, which would have been a small increase. The year-end price was $56, a huge decrease. And all economists that participated in this study, 72 out of 72 that participated, were looking for higher rates and lower bond prices in 2014, and they were all exactly wrong. Remember, higher and lower, two choices they could have made, all wrong. Experts are wrong all the time when they try to predict earnings, oil prices, rates, unemployment, stock prices, housing, etc. You name it, there's someone prominent making the wrong call all the time. So who do you listen to? They're doing this because they think they know. They've done the research. They're really, really smart people. One of the greatest economists ever, John Kenneth Galbraith, said, I use this quote all the time, the only function of economic forecasting is to make astrology look respectable. His point was that forecasters are all overconfident in their own ability, and the things they're predicting are not predictable. So what do? Well, recognize from the very beginning that overconfidence can lead to wrong-headed risk-taking. Be patient. Let the broadly diversified portfolio grow slowly. Don't be enamored by the siren song of those unpredictable returns. Don't get sucked into the performance game. Make a habit of seriously considering the opposite side of the arguments and recognize luck. It always, always, always could have gone the other way. Another behavioral concept is called mental accounting. Richard Thaler, another pioneer in the field of behavioral economics who coined the term mental accounting, defines it as the inclination to categorize and treat money differently depending on where it comes from, where it's kept, and how it's spent. Imagine for a moment you just won $300 and are asked to choose between two options. You can either put your $300 winnings at risk for a 50% chance to lose 100 and a 50% chance to win 100 more, or you can just keep the $300 in your pocket. Which do you choose? Typically, 70% of people, when asked this question, choose A. Put $100 of their $300 winnings at risk for the chance to win at another 100. Now let's look at the same question another way. You didn't just win $300, but you're starting your night out with the following options. Choice A, 50% chance to win 400 and a 50% chance to win 200. Choice B, sure gain of $300. When the choices are framed this way, the majority, almost 60%, choose B. A and B, just like the former example, A and B are the same in both question 1 and question 2. A is a 50% chance at 200, 50% chance at 400. B is a guaranteed 300. Yet significantly more people choose A in question 1. Why? Mental accounting. The gambler is accounting differently for their starting money and their winnings. When you walk into a casino with $100 and soon find you've turned your 100 into 400, you put the original 100 back in your pocket and continue to gamble with the last 300. Now you're playing with winnings only, with house money. Typically, gamblers are more aggressive with this house money. People have a tendency to create different mental accounts for their original stake in the game and their house money. How does this work when you're investing? Well, it's a lot easier to risk your gains than it is to risk your principal. Unfortunately, in the beginning, all we have is principal. So this makes it harder to make gains because we don't want to risk that principal. And as we do make gains, it makes it more difficult to keep them because we like to take more risk with those gains. We like to risk the house money. So what should you do? The problem with mental accounting is it focuses attention on the smaller pockets of assets and takes the investor's eye away from his or her overall state of wealth, which is, the more important question. Individual investments or accounts will perform better or worse over time, but it is the person's total net worth or overall state of wealth that's most important. When you focus on different investment accounts, you create a whole series of winners and losers. If you look at them one at a time, then the losers can cause the investor a great deal of pain and anxiety, even if the big picture is a gain. This anxiety can translate, and often does translate, into ill-advised plan changes to reduce portfolio risk. To overcome this natural tendency of keeping separate mental accounts, focus instead on measuring success in terms of growth in your overall state of wealth. If your net worth, all of your assets, minus all of your debts, is growing at a rate sufficient to meet your goals, then it shouldn't matter if your Roth IRA is not performing too well at a particular point in time. This is one of the reasons why a comprehensive financial plan is so helpful. It can remind you of your long-term goals, risk tolerance, time horizon, in the midst of all the short-term portfolio noise that is often subject to mental accounting. Now, I don't have to tell you this, we all experience it, but we are leading more and more stressful lives. The more stress we pile on, the more shortcuts we use in our daily reasoning. Why does Steve Jobs, why does Mark Zuckerberg wear the same clothes almost every day? The elimination of choices in one area frees up mental cycles for decisions in other areas. Habit formation is believed to be a way to conserve cognitive resources and make decisions more efficiently, as habits do not require constant reevaluation. This circle is the formation of a habit. Routine, reward, reminder, routine, reward, reminder equals habit. 10 years ago, I weighed in at over 280 pounds. I was horribly out of shape. I had a newborn in the house, and I knew that I had to pull it together in order to keep up when he was older. In the beginning, it required a lot of mental energy and effort just to start the workout. I had to figure out what to do. I had to get myself there, and only then did I have the workout itself. Getting to the gym was almost as hard as working out. That's a bad habit. Today, 70 pounds lighter, after following the discipline religiously, it has become a good habit. It is no longer work or effort to start my workout. I don't need to think about what to do, though the workout itself has gotten quite a bit more intense. Thankfully, getting started in the morning is as automatic as brushing my teeth. I have formed a positive habit. Routines and habits help us reduce the workload of everyday decisions, but it also does something else, and this is really important. Behavioral economists refer to this as the recency bias, which is defined as the psychological phenomenon wherein we tend to give greater importance to events or developments that have occurred recently than to those that have taken place in the deeper past. In other words, we're likely to consider immediate short-term phenomena as more important than longer-term trends when we're making decisions. This is evident in the Bloomberg survey of the market strategists, the smart people, who gave us their highest stock weightings at the very week of the biggest bubble burst in the internet and the lowest weightings in the depth of the Great Recession. They were absolutely wrong because they were straight line thinking. The chart to the left shows the steady, painful 2-year decline that ended in 2009. If you were anything but a simple-minded asset allocation rebalancing investor, you probably would have projected that red line and decided to sell equities until the coast was clear. Most people, listening to or reading the long list of media pundits recite all the reasons they should be very, very afraid, followed this path. You can just see a sample of the media headlines there on the right around that projected red line. While the simple-minded asset allocator just rebalanced through the process effortlessly, mindlessly. Sure, they felt the pain of loss, but they had a process. They took some of their safe assets, purchased equities somewhere near their low in early 2009. The straight line thinking of recency bias tricks us into believing that that which has just happened will continue on into the future. When gold is up, people want to buy gold. When oil is up, they want to buy oil. When large company stocks are up, they want to keep buying large company stocks. Sounds like today. Of course, we've had 6 years of incredibly strong markets, and the brainless activity of rebalancing has had us selling those bits that have done really well, U.S. large company stocks, and buying foreign equities and smaller company stocks. This is the move that I get questioned on regularly. Why am I selling that which has done well and buying that which has done less well? Am I an idiot? I'm questioned for rebalancing because everyone is projecting the green line. Partially, this is because the economists, media headlines, and Wall Street's paid shills are explaining how the bull market can continue. There's not enough optimism yet. Valuations aren't really that high. There's no indication of real recession. And who knows? Maybe they're right. I don't know. I don't know how long this will last. And importantly, no one else knows either. It's the stuff of crystal balls. If it does continue, and you're betting on it to continue, good for you. One more year. If it doesn't, you're going to lose a bundle, and I'm not comfortable making this bet. So I will continue with my plan-based asset allocation. I will stay diversified, and I will rebalance regularly because I know that works over time through lots of different environments. There are many more mind games we could go into, but if you focus on understanding these few and creating a process of investing that manages them, you're going to be okay. We think that once you have a portfolio and you're invested, the things you should do are simple. It shouldn't take any more than a couple hours a year, maybe 5 hours a year. So let's consider how to bring it all together and manage this ongoing investment process. There's 3 or 4 points I'm going to make here, but first, once you're investing, keep investing. Add more, add it more often. There's no risk in having too much at the end. The only risk is not having enough. If you have too much, you have a legacy for your family or for the things you care about. Dollar cost averaging is not a one and done kind of thing. It's a consistency thing that improves as you add more and more to your regular investment amounts. Your goal is to continuously and patiently lower your cost basis over time. This thing called dollar cost averaging can't guarantee you a profit or guarantee you that you'll avoid a loss. A regular fixed dollar investment will result in a lower average price per share over time, assuming you continue to invest. In the example here, let's say that you decide to invest $300 each month towards your retirement. Because you invest the same amount every month, you automatically buy more shares when prices are low, and fewer shares when prices are high. Over time, you'll find that your average cost per share is actually less than the average market price per share over the time you invested. The shares you end up buying by default when markets crash are the most important shares you will buy. They are the ones that reduce your average cost basis the most. If you're currently contributing automatically to a 401k plan, you're actually already doing this. So what do? Keep it up. And save more. One of my favorite bloggers, Ben Carlson of A Wealth of Common Sense, says it like this. He says, it's not a top call or a trading tactic that you can implement right now to hedge out your portfolio, but saving more money is still one of the best ways to reduce risk in the markets. Bubble or no bubble, saving more money provides a margin of safety against the possibility of lower market returns in the future. Your asset base, from which you will draw the money to cover your next vacation, to pay for your children's education, to support your parents if that's necessary, and for your own lifestyle-sustaining income in retirement, can increase in two ways and only two ways. You will add to it through savings, and your portfolio will grow over time. So it's savings or return. If you model big returns, then portfolio growth can be pretty important and the most important of the two. However, hopefully by now that you see this for the mistake that it is. No one can consistently achieve those big long-term returns. No one. And the constant chase for improved returns has actually hurt investors. So we're left relying on a simple plan-based portfolio and our savings rate to boost our asset base and our future income stream. Savings rate wins over return long-term. There is a number in your financial plan that you need to reach that when you reach it, you can be done working for income. The only thing that is within your control in terms of reaching that number is your savings rate. You don't, no one else does either, have any idea how the markets will perform between now and the end. Therefore, the highest probability action you can take to get there sooner is to boost your savings rate. And finally, rebalance. Well, third, rebalance. No matter what we do, our portfolio will someday become out of balance, as above. The process of rebalancing is the process of putting the portfolio back in balance by selling those assets that have done well in the short term and buying those assets that have done relatively less well in the short term. Your asset allocation should stay relatively constant over time unless your financial situation changes dramatically. In most cases, you want to review your allocation once or twice and maybe make adjustments once or twice a year. This is because as investments grow or shrink in value over time, the actual allocation will begin to shift away from your original model allocation. To maintain the balance of your investment strategy, you must trim positions that have had strong returns and increase holdings that have underperformed. There are two ways to approach this. You can do it strategically, which means just adjusting back to your original allocation, or there's a lot of folks that say they can do it tactically, which means you set a new allocation based on any relevant changes in your needs or in markets, and you adjust your holdings accordingly. I think the simple way is to keep it strategic. To illustrate, let's look at an example of strategic rebalancing. The pie chart on the left, let's say you invest $50,000, and then the next year, let's say that your equity returns 11%, fixed income returns 5%, cash returns 3%. The right pie chart is the result. Your allocation is changed into that second pie. To bring this portfolio back into the original allocation, you'll need to reduce the amount held in equities, increase the amount held in bonds and cash. This is to compensate for the fact that equities grew in value at a much higher rate than the other two asset types. Obviously, when you make these changes, you're going to incur potentially some trading expenses and you might generate some taxes. But not rebalancing will leave the risk in the portfolio from that one piece going up, 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 up. You have to weigh which is more important. I recommend rebalancing annually. This chart shows the benefits of rebalancing. It shows us not rebalancing versus rebalancing, starting simply with a 50-50 allocation between two different holdings. This is a very simple portfolio. In this case, growth and value stocks during the dot-com era. We can see how the rebalanced portfolio looks compared to the unrebalanced portfolio. In this example, rebalancing occurred when either allocation deviated more than 5% from the original allocation. You can see in the yellow line those little black circles. That disciplined rebalancing would have kept our growth exposure much more in line with our plan. Where if we had not been rebalancing, you see the blue line grow to the peak of 75% of the total portfolio. This is a huge overexposure in terms of our desired planned risk level. And it happens just before the crash in early 2000. Rebalancing brainlessly protects us from running over the cliff with the herd. That's why we recommend it. Now you've heard me say this, and I'm going to say this many, many more times if you pay attention to what I say. Almost all investors and all financial news and commentary consider the daily flow of market data and economic information a critical part of the decision-making process. They have to believe this to justify their existence. Unfortunately, the financial science doesn't support it. The people who support this position are financial product manufacturers and their media brethren that want to keep you shifting and moving. Learning to treat them like the noise they are is the beginning of personal financial wisdom. I recommend we start with that now. So real quick, thanks so much for attending our After You Invest, the Mind Games Begin webinar. We'll make the 3-part investing series available again to our subscribers very soon. We got to do some editing and stuff. If you missed any part of it, I hope you'll join us to learn what you missed. In the meantime, just do a few simple things. Plan well, pay down that high interest debt, keep investing simple, stay diversified, dollar cost average. And then recognize the mental games and pay attention to how your mind makes you feel about your investments. There will always be somebody doing better than you. Most of that will be seasonal. Stick with your plan, you'll get there. As always, if you think this is valuable, help me spread the word. Follow us on Twitter, tweet about us, like us on Facebook, post some of our events. Become part of the conversation. Reach out, tell someone to subscribe. Help someone else educate themselves and start to get ahead. Thanks again for spending so much time with us today and through all 3 parts of this Mindful Investing series. And I hope you've enjoyed it and learned something. Again, I just got to remind everybody, this is general information. It's not specific advice. I don't know your plan. You know your plan. If you have questions when this is all over, ask them.